Things are getting bullish. Goldman Sachs just lifted the S&P 500 price target to 5,600 for 2024, and it is the highest price target right now on Wall Street, proving the age-old saying that sentiment follows price. Just 6 months ago, Goldman Sachs' 2024 prediction was 4,700, and that was when the index traded around the 4,750 area. So can the 5,600 price target be achieved in 2024? And today, we're going to break down the S&P 500, looking at the average company's balance sheets, income statements, as well as cash flows to see if we can actually hit these targets and if valuations warrant the current prices. We're also going to be diving into the consumer health. Plenty of people in my comments took issue with some of the charts I showed you guys earlier on the week with regards to excess savings as well as initial jobless claims, and I'm here to tell you guys why you're wrong. Lastly, we also need to talk about market breadth. The S&P 500 keeps making new highs, but market breadth is looking really weak. So will the S&P 500 unwind to the downside next week, or will the market broaden out? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. It really helps me out. Let's get into it. This is the daily heat map here of the S&P 500, a pretty red day across the board. And even in the sectors where you thought it would be pretty green, it was red. I mean, look at semiconductors. Apart from AVGO, Broadcom, and Nvidia, semiconductors was actually pretty red. You can see right here, as well as semiconductor equipment manufacturers, pretty red or pretty flat across the board. Apple gave some back, Microsoft was very flat, and Adobe up 14% after its stellar earnings. Other than the big names, you know, Nvidia, AVGO, Google, Meta, Microsoft, Apple, pretty red across the board. And every single sector was red here today, except for consumer staples, information technology, and comm services. Other than that, you know, we saw broad-based selling, and the worst performing sectors was energy, materials, and industrial. So anything tied to, you know, commodities. I know industrials aren't necessarily tied to the price of the commodities, but these sectors work with a ton of steel, copper, gold, silver, etc. So commodity driven sectors definitely took it on the chin. And again, you know, the exact same trade we've seen this entire week, we saw here today, technology outperforming and everything lagging behind. And it's very clear here in the weekly heat map. You can see that, you know, semiconductors, Microsoft, Apple, technology, these names right here, they were the real winners. They held up the entire market. We did see rate sensitive sectors perform as well. Real estate right here. And then the big names in each sector. Look at Costco, Walmart, Eli Lilly, Google, Meta here in comm services, Home Depot here in the discretionary space. Amazon was largely flat in the broad context of everything, as well as Tesla. So the big names, the big players were the real winners, as well as technology. And the market this week was buying technology, buying semiconductors, as well as digesting a lot of the economic data we got, the Fed, PPI, CPI, and that just meant that tech outperformed every other sector. The worst performing sector this week, as you can see, was actually just like regional banks, financials, energy, metals, and mining. So, you know, commodity driven sectors, as well as financials. And that's because we got a little bit of a hawkish Fed in terms of longer term dot plot projections. And that's why, you know, these sectors right here really took it on the chin this week. People were buying technology. The S&P 500 returned 1.64% for the week. And what we also saw was pretty good performance here in home builders as well as real estate as a whole. This week, we got definite confirmation that rate hikes are 100% off the table. And I think we should see stark outperformance in these sectors for the rest of 2024 and 2025. Discretionary, XLU, utilities, comm services, healthcare, GDX, materials, and staples. Apart from discretionary and utilities, all of these sectors pretty much lost here on the week in favor of stuff like software, tech, and semiconductors. All in all, it was a very crazy week. But again, like I said, the market just digesting data, looking at tech, AVGO, Adobe, stuff like Oracle, and putting their money into places that are growing earnings and where guidance looks favorable, and selling stocks that are tied to rates and the macro economy. Now, looking at the charts, the S&P 500 finished down 0.4% for the day. Nasdaq 100, the biggest winner, up 0.42%, and the weekly chart looking very bullish. Look at that weekly candle at all-time highs. Does it get any more bullish than that? Back to the daily chart, and the IWM looking a little sick the last 3 days after this huge gap up. Saw consistent selling pressure. We'll see if we bounce here at the 198 area. Very similar situation in the RSP at a very critical zone here at 162. Below this, we could actually sell off to 158. In the context of the broad market selling off today, 10-year yield was actually down. The 30-year bond was actually down as well, but we did see mild up momentum here in the 2-year yield, up 0.13% here on Friday, but down overall for the week. TLT, long-term treasuries gained 0.84% and actually hit our first target of 94.76. The dollar continues to gain despite the petrodollar news. Gold was up 1.37% today. Silver up a casual 2%, looking like the $29 level is good support, and then crude looking like an island top forming at the highs right here. So let's dive into the S&P 500. A couple of things, looking at the weekly chart firstly. So guys, you look at the chart, you look at the technicals, right? Very, very bullish. Higher highs, higher lows, making a new all-time weekly closing high. The second all-time weekly closing high in a row. We had one last week, and this candle looks very, very strong. A mild wick at the top here, just because of some of the selling we saw towards the end of day. Just a bit of risk off here on the weekend. Nothing to say other than the fact that this looks bullish on the weekly zone. And if we are to look at support zones here on the weekly chart, I would say the very first support zone would probably be this 49.85 area, this 5,000 area. And really, we have a lot of room to pull back to. That's an 8.35% pullback there. So in other words, the S&P 500 could pull all the way back to right here, still be in a technical uptrend, and then go from there. Breaking it down even further, let's look at the daily chart. Now, I do want to preface this with something. Firstly, market breadth has actually been terrible. This right here is the advanced decline line, and you can see that throughout this year, as the S&P 500 has made higher highs, new all-time highs at every single level, the ADL line has actually followed suit. That is simply not the case. You can actually see a very, very strong divergence with the ADL line moving lower as we actually move higher. So a small number of stocks is moving the market to new all-time highs. That's often not a healthy sign. However, if the average stock was to participate over the next coming week, and let's say mega caps continue to trade sideways, we could 100% continue to push to all-time highs or continue to move higher to the 5,500 area. And that's actually what I kind of see based on the gamma situation. Now, we had multiple daily closing highs, actually 4 in a row here on Monday, Tuesday, the gap up on Wednesday, Thursday, and then we had a mild pullback, still a very green candle. And if you actually have a look at Friday's candle, let's just zoom in a bit more. You can actually see some very, very interesting trade. This right here, when you see wicks like this at the bottom, these are price rejections. This pretty much means that buyers are coming in at this 5,400 area and buying the dip right here. And they did this on Thursday. They did this here on Friday too. If we dive into the 5-minute chart and just zoom out, we can see it very, very clearly. You see, this is the gap down, and then we just bought dips. This is exactly what positive gamma price action looks like. Higher highs, higher lows. Look, buy dips, sell rips, buy dips, sell rips, buy dips, sell rips, buy dips, and then we close the day right there. That's what positive gamma price action looks like. And we sort of just trend upward throughout the day. That's what normally happens. So very interesting price action. And I do think what we're probably going to see throughout this week is into OPEX, because the 5,500 strike, the gamma flip zone is now at 5,500. I think what we're going to do is buy dips, sell rips to the 5,500 area. But I think we're going to see the broad market participate and then the mega caps trade sideways. And that's probably going to lead us to sort of like get to the 5,500 area. We might see mild outperformance to continue in semis, especially after that AFGO report. And that's going to flow on into NVIDIA, the other strong semi names like ASML. We'll also continue to see Apple rally. I think Microsoft too. Both those names will always rally when the other is rallying, because they are the biggest stocks in the world. And guys, when you have stocks like Apple, Microsoft, and NVIDIA all participating in this rally, the 3 biggest stocks in the world that make up 15% of the S&P 500, 30% of the Nasdaq 100, you're going to see this type of performance here. Do expect that to continue, and do expect the average stock to also participate in the weeks ahead. Earnings will only get better. We are starting to see yields pull back in a very, very big way. Inflation is cooling and the consumer is still pretty strong. So next week, I think we can actually look to, the 5350 level as the very first zone of support. If we do pull back, maybe close this gap, we can definitely see a pullback here, and then we should find support at the 5350 level and then continue the movement higher. That is if we do pull back. Otherwise, I think we can just continue the rally, higher highs, higher lows, especially because we don't have a lot of data next week, as well as earnings, which means price is going to trade a lot on the technicals. Technicals are bullish. We made 4 new all-time closing daily highs, a weekly closing high. Risk is to the upside right now, but if we do pull back, look to support zones at 5350, but look to 5500 as the ultimate zone for the end of next week into June OPEX. Now, looking at the fear and greed index, very, very interesting dynamic. We should actually start calling this the fear of missing out index, because the S&P 500 and the Nasdaq 100 put out new all-time closing highs pretty much every single day this week, and we're still here in the fear zone. And this just goes to show some of the breadth dynamics we've been seeing in the market. And while according to Goldman Sachs, breadth isn't extremely narrow, which is below this line right here, we're currently situated at 19. I do expect that to probably fall next week, and breadth is pretty narrow. We're actually seeing the average stock trade sideways while the mega cap stock or the average tech stock is moving higher. And this is the year-to-date performance of the major indices. So we have the S&P 500, the Nasdaq 100, the RSP, the equal weight, and the Russell 2000. And you can clearly see the divide on this chart. This is the year-to-date performance, and you can see that the RSP has returned 4.83% right here. The Russell 2000 has returned about 0.5% against the S&P 500 and the Nasdaq. You know exactly what these indices are. The S&P 500 returning just under 14% and the Nasdaq 16.3%. And there's a clear divide in performance, and pretty much if you don't have an overweight or market weight allocation to stuff like Microsoft, to stuff like Nvidia, Apple right now, Google, and Meta, you're just going to underperform the market right now. And that's actually a big problem for fund managers who don't have a market weight allocation to some of these bigger tech names, and they have more of an equal weight portfolio. That's why you see their market returns closer to this. Now, I do actually have a second chart here, and it's just a bit of an opportunity cost having held the Russell 2000. You can actually see this is the return of cash in a high interest 4.5% savings account, and up until right now you would have returned 2.18% in that money market fund against the Russell 2000's 0.48%. So this year so far it is better to hold cash than the Russell 2000, but it's been better to hold every other index over cash, which is very, very interesting. Now, part of the reason why the Russell 2000 has actually underperformed the broad market has to just do with earnings. You can see that even though the Russell 2000 earnings is slightly declining right here, you have to understand that that's coming from last year's base, which was absolutely terrible earnings in the Russell last year. And we're actually seeing a further decline, even though it's ever so slightly, of 0.9% year in earnings and 0.3% year in revenue. Some of these sectors, stuff like technology, financials, consumer staples, returning negative 10% on a year-over-year basis, negative 35.5%, negative 42.1%. Com services, that is horrendous earnings right there. And the same is true here on the revenue side. However, if you actually just remove this sector right here, just remove energy from the fold, you actually see earnings improve to 12.3%, which is not bad at all, and then 0.4%. But while the S&P 500 this quarter has actually returned 8% earnings growth, 4% plus on the revenue side, the Russell 2000 is actually still hurting very, very badly, and that is part of the divide. Now, this isn't just for the Russell 2000. This goes for the Magnificent Seven, these tech stocks, as well as the broader market in the S&P 500. And nothing spells it out as clear as this chart right here. You can clearly see that in the first quarter, Magnificent Seven earnings growth, this green bar right here, is actually up 37% in the first quarter year over year, whereas the average S&P 500 stock, so this is the 493, is actually down for this quarter, and hence why the divide between these Magnificent Seven tech stocks and the broader market. However, that is expected to change here in the second, third, and fourth quarter. We will see earnings accelerate over the next 3 quarters, outpacing the Magnificent Seven. That's not to say the Magnificent Seven aren't going to return stellar earnings. 15% growth here, 14 and 24%. It's just that in the fourth quarter, 493 earnings are expected to be 18%, and then 6% here in the second and third quarters of 2024. But regardless of earnings, the average S&P 500 company is still very, very healthy and has actually improved remarkably since the GFC. This right here is S&P 500 non-financials net debt to equity. So essentially the debt to equity ratio, and generally speaking, anything between 1.5 to 2 is considered good. Anything above this level is considered unfavorable. Anything below is considered very, very good. And essentially just compares the amount of debt a company has to its shareholder equity. And you can see here that S&P 500 companies hold 0.6 the amount of debt to shareholder equity, and that's very, very healthy. In fact, we saw this number accelerate from about the mid-80s into the early 2000s, and even at this point right here, it wasn't super unhealthy, but we do know what happened with the GFC because there were majorly over-leveraged companies that really skewed this. However, you could see that in 2014 and right now here in 2024, S&P 500 debt to equity is at very, very healthy levels. And at the same time, companies are also making record amounts of free cash flow. This is free cash flow as a percentage of sales. This number has literally increased at the same time as earnings have increased. And pretty much from the year 1995, as companies have actually earned a lot more money, they've actually increased their operating leverage, increasing their free cash flow as a percentage of sales. Essentially, companies companies have become much more efficient. But since 1995, this number has very close to 3x, from about under the 4, maybe 3.8, 3.7 to the 11.4% range. So anywhere from a 2 to 3x in free cash flow as a percentage of sales. So essentially, if a company goes out and makes $10 billion for the year, 1.4 billion of that can be given to shareholders in the form of buybacks or dividends, or the management team can just use this money for mergers, acquisitions, paying down debt, or further reinvestment into the company. Now, what a lot of S&P 500 companies are doing with their free cash flow is actually buybacks, and S&P 500 buybacks are likely to continue to rise based on the read from BofA's corporate clients. This right here is S&P 500 total quarterly buybacks and the 4-week average buyback. So I'm guessing these are buybacks that BofA as the investment firm do for their clients. And you can actually see here that buybacks year over year are actually increasing, and the 4-week average is moving up in a very big way. And they do expect this to continue to rise. So companies are making a lot of cash right now, record amounts of free cash flow, and they're giving that money back to shareholders. And this is especially true for some of these larger mega cap companies. You see, when you have someone like Lina Khan and the FTC barring almost every acquisition, tons of regulation, laws in Europe. I mean, look at this. Amazon couldn't even buy a vacuum cleaner company. A lot of these mega cap companies who just have a ton of cash are going to put it into R&D, organic growth, dividends, and share buybacks. And you can see the fruits of their labor in the data. Global M&A activity since Q1 2022 has actually been on a very steady downtrend. It did pick up ever so slightly here in Q1 relative to Q3, Q2, and Q1 of 2023. But Q2 expectations right here is at 323 billion, the lowest quarter of any in 2023 and 2022. So mergers and acquisitions aren't happening, but that's not to say companies aren't spending. Stocks with an abundance of cash are paying dividends, engaging in share buybacks, and they're just focusing on organic growth. And at the end of the day, that's just going to make the core business models of these companies much more stronger. So let's talk a bit about the macro. So yesterday we got initial jobless claims, guys. I didn't cover it in depth, but claims came in really hot, 242 instead of 225, and the market saw this as weak, and this is a pretty ugly number, all things considered. But when you look at it in aggregate, not actually as bad as you think it would be. Number one, this right here is 2024. This right here is the 2023 trend, 22, and then the 2018 to 2019 average. Initial claims right here is actually doing exactly what it normally does around this time of year, which is increase, level off, and then it actually does come down a little bit later here in the July-August period. Something else to note, we're actually trending below initial jobless claims here compared to 2023 and slightly above the 2018 to 2019 average. Furthermore, continuing claims as a percentage of covered employment, which is this right here, the insured unemployment rate, is at 1.1%, exactly the same as the same week of 2023 and 2018-2019. Layoffs remain low, and the laid off worker are finding jobs, which is why continuing claims aren't rising as much. But it's not as easy to find a job like in 2022, which is why continuing claims aren't falling. Secondly, I saw this note in a comment section on Twitter, very interesting with regards to initial jobless claims. He says, one note on claims, they rose because the first week of June fell, and June 7th for claims count purposes. When that happens, NSA claims rise sharply in the first week of June instead of the second week of June. SA Algo expects a small decline. Long story short, normally when the count gets a bit weird with regards to the days that they count, we normally see a huge uptick in one week and then a decline in the other week. And that's part of the reason why we actually got a bit of a hot number here with regards to the forecast number. Now, another point of contention in my videos is a lot of people said that here excess savings are being depleted, and I was looking at 800 billion as a really good thing because that's just excess savings that consumers have to fall back on. But many people said, no, excess savings are being depleted, it's a bad thing. But let's actually read a tweet from Rick Reeder with regards to excess savings. Debunking a common myth on excess savings. There are several widely circulated excess savings models that show the US consumer having spent down the above normal savings accumulated during the pandemic. These models, which are ultimately only illustrative in nature, implicitly assume that the natural savings rate is 8% or higher. We believe these assumptions are far too conservative and fail to acknowledge the elevated levels of household wealth today. In fact, we we would say that as compared to arguing all excess savings are depleted, the orange line below, it is more reasonable to argue that there has been no depletion of excess savings at all, purple line below. Of course, as with most things, the right answer is probably somewhere between the extremes, and we believe it's best to look at a range of outcomes. How could it be that excess savings has not been depleted at all while many things can influence the savings rate, especially anything that affects consumer psychology in a big way? Primary driver in the US over the past 40 years has been wealth, as measured by net worth divided by disposable income. It is intuitive that as households experience higher wealth, they feel less need to save. The relationship was crystal clear from 1985 to 2010. The post-GFC period saw a psychological shift towards higher savings, but the relationship returned once the economy finally recovered in 2018. For anyone wondering why the savings rate is so low today, look no further than the new highs in net worth divided by disposable income. We can see this confirmed when looking at household deposits as well, which is brilliantly depicted by Cameron Kreis from Bloomberg. Household deposits as a percentage of GDP remain well above trend and higher than any time outside the pandemic over the past 40 years. In conclusion, we believe that high levels of net worth divided by disposable income and still high levels of household deposits will allow for a lower natural savings rate and stubbornly resilient US consumer. Allow for a lower natural savings rate and a stubbornly resilient US consumer. So don't buy into the fear, uncertainty, and doubt. Just follow the data. There's always two sides to a story. Now guys, we're going to look at a bit of charts. This is a bunch of sectors, ETFs against the S&P 500, and it just determines how certain sectors are looking against the broad market. Now this right here is the XLK against the SPY. Just to give you guys a bit of context, if this chart is going up, the index or the sector or the stock is outperforming the SPY. If it's going down, the SPY is outperforming that stock, i.e. right here, XLK versus the SPY. You can actually see that since May, we've seen a ramp up in technology stocks. In other words, it's better to own tech against the S&P 500, but it was better to own the market as a whole from about top of February all the way into May. That's not to say that the SPY had a negative return. In fact, the S&P 500 is up 13%, which is that technology has vastly outperformed the S&P 500 since May. And you can actually see that we've had slight outperformance in technology, but pretty much going sideways. There's been volatility to the upside and downside. The next chart we're looking at is TLT, or bonds, long-term treasuries against the S&P 500. And you can see it's just been better to own equities all year, but that is looking like it might change with this double bottom, a higher low formation here in TLT. If we can go ahead, break this high, it's then onward and upward for long-term bonds. And I do think that the risk to reward for bonds looks really good at these levels, especially for the rest of the year if cuts do materialize in the September period. Looking at defensives versus the SPY, you can see that we did have mild outperformance when the market got a bit jittery here in April. The S&P 500 was down about 5% in April, but when you look at it in aggregate, we couldn't break some of these highs. This is a lower high, and it's just been downward momentum here for defensives. It's definitely been better to hold cyclicals, to hold growth, and that is still the case right now. And I do think that growth will continue to outperform here in 2024, especially if we get rate cuts. The environment is very risk on. Now, looking at growth versus value, we actually did see mild outperformance in energy. This is XLE versus the SPY. I've used it as the value barometer, but I should have probably used something else like SPYV, but this is what I've done. This is what we're going to use. And you can see that growth has outperformed value, especially recently, and it's far better to hold growth. There was a time when, again, the market did get jittery and energy did outperform, especially when we saw that rally in oil. For this year, growth or the S&P 500 has clearly outperformed value, and it's better to hold cyclical assets, growth assets over value assets. Lastly, this right here is just the chart inverted. So if the chart's going up, the S&P 500 is outperforming, and this is the S&P 500 or US stocks against the ACW or the All Country World Index. Pretty much you can see here that it has been far better to be in the S&P 500 to hold US stocks. And pretty much what all of these charts are telling us right now is that for 2024, it is best to be in US stocks and it's best to be in growth areas over anything else. And you can even see from February to May, we pretty much went sideways. And that just tells us that the S&P 500 and the ACWI index gained or lost the exact same amount, but then we've seen massive outperformance here in the S&P 500. I do think that this is probably not going to continue. I think we're probably going to see more sideways action. I am actually very bullish on European stocks as well as Asia stocks, but that's not to say that the US is going to have negative returns. I still think the S&P 500 is a great place to store your money. Now, looking at earnings for next week, A pretty light week of earnings, all things considered. Nothing I'm interested in at all except for Accenture right here. I actually used to hold these guys in the undervalued portfolio. I got rid of them in the first quarter, so we'll see how they perform in earnings here. So a pretty light week of earnings and a light week of data as well. The focus next week will be on retail sales, industrial production, and housing data. So we get retail sales and industrial production pretty early here on in the week on the 18th, and then we get building permits and housing starts here on the 20th. That's really it. A very light week of earnings, a very light week of data, but I actually welcome it because of the week that we've just had. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, like this video, and leave a comment for the algorithm. Cheers.